Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon, all. I'm not sure when that meeting started, but kind of like it. Honestly, I was getting in a bit of a zone. It's kind of a little bit of lo-fi, zoning in, getting ready to grind it out. All right, well, we got a few people in. I know I teased out this morning. Apologies for the kind of late Spaces announcement via Twitter in regards to setting the reminder, but it's been a busy day here at the Connecticut office. Typically is, especially when I'm hitting the road first thing this morning. A bit of a long day. All of a sudden, not that I'm not usually up 5 o'clock, but it just makes it a little longer when you're on the road. If I were knocking on just at the desk, or 5:30, excuse me. But anyway, let's get right into it. You guys did not join Spaces Notebook Review in order to hear about my travel. But if you're new to this, obviously, we are going through signals, the data, how one should be looking at their portfolio construction and risk managing those decisions. I think Keith did a phenomenal job on the macro show today, walking people through and slowing it down a little bit in terms of how to think through sizing, timing, how to think through risk management. So if you haven't watched that, obviously it's free all access week. This is free every week, but this week is certainly a good one if you're either new to Hedgeye or looking at getting further into the Hedgeye process. We really open up a lot of the different product sets in free all access week. So definitely take advantage of that and go watch the macro show. This was again, he did a masterclass in terms of just walking people through how to think through different setups and stuff like that. In terms of what's bouncing off the page, a little bit of a noisy day out there, to be honest. At least I thought it was noisy. I thought it was pretty noisy on Twitter. I was pretty kind of head down, grinding through things. But it felt like every time I hopped on Twitter, it was just people were just screaming about Bitcoin and just whatever, market going, doing things. I think this is a big important one in terms of just trying to block out the noise, right? If you're long Bitcoin, if you're not long Bitcoin, we've got a risk management system in place and a process in place to help guide you through that, to get you in, get you out. But at the end of the day, it's really what's in your portfolio. So if you're not long Bitcoin, then I'd really encourage you just to kind of block out everything that's kind of happening in that space. It can obviously be very, very noisy. You get a lot of FOMO. You can make stupid decisions when you're doing that. Kind of same with NVIDIA and some of the tech, right? So if we haven't had this call for about 2 weeks now. Last week was February break for the kids, so just took a week off. So we didn't get a chance to kind of talk about NVIDIA earnings, stuff like that. But I think the most important things is just really what's on the page. I tweeted out about this, I think, on Monday in terms of we really just simplify things to having bullish trends in your portfolio that can really alleviate a lot of anxiety and a lot of stress. And so, right now, in terms of, bigger picture things that are bullish trends, you've got the S&P 500, you've got the NASDAQ, the Russell. China just went bullish trend. So that's a new one on the board. We were actually adding that in the re-rank in portfolio solutions today. Nikkei remains, Japan equities remain bullish trend. India remains bullish trend. Germany's bullish trend. You've got XLK, the tech ETF is bullish trend. You've got insurance companies, IAK is bullish trend. Momentum is bullish trend. Pink is bullish trend. Bulk dry shipping is bullish trend. Call it QB, like, look, I'm back. Somebody give me a heads up, letting me know that I'm back. Shoot. Am I back, guys? There's a phone call that came in. Hopefully I'm back. Can you guys hear me okay? All right, perfect. Thanks, Philip. Yeah, phone call came in. Sorry about that. It's the downside of spaces and on the phone. But anyway, my point is there's a lot of shit that's bullish trend. Excuse my language, but there's a lot of stuff that's bullish trend. Oil is bullish trend. Natty gas is bearish trend. So stay away from that bad boy. Gold remains bearish, bullish trend. Copper just turned bullish trend. So it's these phase transitions. We talked about that a lot. This is a great time to kind of take advantage of the pullback, but they can be noisy, right? They can be kind of choppy when they're making those phase transitions. But adding a little bit, when you got multiple things, and Keith's talked about this on Macro Show the last few days, but you have multiple things that are signaling, similar sets, right? So you got copper going bullish trend, you've got the Shanghai composite, SSEC has gone bullish trend. You've got underlying components inside of China and China factors exposures that are going bullish trend, like wind. These are all similar sets, right? So you want to be having these things inside your portfolio. You don't have to have all of them on your portfolio. Jonesy on the Macro today said that he kind of caps out at 15 to 20 positions inside of his portfolio. That's where he really maxes out. So the big thing is like understanding your personal portfolio, right? Like I've got about 20. I'm similar to Jonesy, probably about 20, 25, but I've brought that down when I first started this process and kind of diving into the Hedgeye research. I was much closer to Keith in terms of 40, 50, probably at one point 70 positions, a lot of individual names, stuff like that. I've curtailed that, one from a timing standpoint, just don't have enough time anymore, and two, just kind of I try to have some of the things that I think are the highest conviction or sort of have the best signal strengths. So KSA is one that Keith added today that's been in my portfolio for a week or two now. So Saudi Arabia, right, when I saw oil change, kind of like moved to bullish trend, I guess that was about a week or 2 weeks ago. I went hunting for some oil related exposures, right? So that was kind of what I did. It's all very personal. So you just got to kind of understand what's good for you and what you should be doing inside your portfolio. But my point is I've got about 20 positions, individual 25, and then I trade some options. So that's what I kind of more actively manage are the options positions, while trying to kind of capture the trending, bullish trends and, be at max position sizing for, based on volatility adjusted, for those equities or for those ETFs. So some of those ones would be, I got rid of QQQs to balance. So that was a mistake, but SPY is in there. XLV, XLI, industrial has been a great exposure to have on. XLP, consumer staples, healthcare. So again, these things are all bullish trends and certainly acting well and performing well. So today, as I said, a little bit noisy. Just kind of a little bit of a general pullback. I tweeted out about the flip line. We bounced off that bad boy a number of times. I think we hit it like 4 or 5 times. I think we bounced right off of it, like basically at like 350. 350. We went right down to the flip line, which today was 50.64 on the S&P 500 on the SPX. We bounced right off of that. So 1, 2, 3, 4, 5, 6, 7. We hit that. We were kind of right around that line. Hit it. Went up and around about 5 to 7 times, depending on how you want to think about it or look at it. Again, I'm looking at like the 5 minute chart. So that's what I calculate here. If you want to be more granular, go be more granular. But at the same time, that flip line just is really important. It's really important to understand where it is, how it transacts, what it does, how dealers have to react to it. And there's a point in time where it looked like it was going to kind of go negative, and dealers are going to have to step on the gas. Got to reposition their portfolios, but zero DTE or again, I tweeted this out so you can go look at the timeline, but they really were kind of right around 505, 506, 507. So kind of a lot of pin action today. And to me, I think there's a good opportunity to be adding to some of your Russell. So kind of your smaller caps, broaden that exposure out. So whether it be through IWM, we prefer IWO in terms of growth. We much prefer growth at the moment. And you're seeing that as well through like SPMO. So like momentum has been just an absolute, gangbusters even today on this kind of slight sideways / bear, small pullback. SPMO kind of held in and really maintained its sort of, didn't close at an all-time high, but certainly was kind of right there in terms of new 1 month or holding that 1 month and 3 months, recent 3 month and 1 month highs. So that's all a good thing. In terms of opportunities today, ones that I think are really coming about as we continue to progress here in 2024. EMX China is a really good example. We've talked about this a number of times. I know, kind of took about it a bit more from a capital allocation standpoint, the work that I do with David Salem. Thanks for listening, him, big guy. But yeah, EMX China, I think is a great opportunity here this year as an asset that could really benefit from being in your portfolio. Keith actually added that to his portfolio solutions product this morning at a minimum sizing. So that's always helpful to see him adding it on something that you also think is a good asset allocation. So EMX China, India had a little bit of pullback. Some of those Asian equities, again, we're kind of broadening the horizon. I think it's a really good example here at Hedgeye where we can really go anywhere, right? So we can go anywhere, but to steal a line from Salem, you don't want to go everywhere. So be much more specific and directional in terms of what's in the portfolio. So not all of the Eurozone is a good exposure. Things like Spain, haven't acted as well. But things like the Netherlands and, as I said, Germany's bullish trend. So those areas have been really great areas to have on inside the portfolio. So kind of continuing to look through the Eurozone, look through certain aspects of Asia. Not all of Asia is the same. South Korea is a new one that kind of recently turned bullish and was added to the portfolio solutions as well. So you've got the Nikkei in bullish trend. You got China now in bullish trend. You got India in bullish trend. You got South Korea in bullish trend. You got a lot of bullish trends around the world. So, this is when a lot of folks can look really good, but you can also look pretty stupid if you're not allocating towards the things that really have the best signal strength. And one crucial way of looking at that and tracking that is by reviewing, are they bullish trend? Are they bullish trade? Right. So keeping the team here at Hedgeye will keep you abreast of those things. But then what you can track inside of the risk range product, obviously, is whether or not they're making higher highs, both on the day-over-day and week-over-week basis. Those are the two time frames that I certainly track. And if they're doing that, if they're putting in a higher high and a higher low, then those are things that are really have continuing to increase their signal strength. And those are ones that you really want to have in your portfolio. Something, Keith addressed this morning in terms of Microsoft. That top end of the risk range is 415 this morning. It was 416 yesterday. It was 419 on the 26th, and it was 422 on the 22nd. So that is actually not the direction that you want to see. You don't want to. You want to see the top end of the risk range to continue to climb higher. So although Microsoft remains bullish trend, it's moved down the list in terms of signal strength. So just these are things that you got to be paying attention to if you want to be doing the work. If you don't want to do the work, then that's cool too. We've got the portfolio solutions product, and you can kind of just track Keith's decision making, what he's doing incrementally from both a sizing and ranked positions in the portfolio. So that's kind of that. Obviously, a big one that we've pivoted away from the last 2 weeks, it would be uranium. That's just started to break down. Again, you should have seen that on the page as you were looking, even when it was in a bullish trend. Trend when it was still signaling bullish trend on the page. Because you saw it putting in lower lows and lower highs. When it starts to kind of really do that, sometimes it's consolidation. All right, consolidation usually is when you got a higher low and a lower high, right? So you got a consolidation. Oftentimes that's volatility is coming out of that asset class, and it can be a really good time, especially if it's been in a bullish trend for a while, to start to accumulate a position inside of that piece of inventory. But what you really don't want to see is lower lows and lower highs, and then for those to kind of basically start to speed up, right? So if you look at URA today, had low in the risk range of 26.65 at the top end of 29.70. If I flip back to the 22nd, that top end of the risk range was 30.77. So basically $1 higher, and the low end was 27.59. So almost $1 higher there too, 90 cents. So again, these are situations, these are similar sets. That you really, that's the opposite of a good thing. And you now see it as neutral on the page. And if you're not out of uranium, I would certainly be, reducing your sizing significantly, if not just completely out altogether, because, finding areas where your hard-earned capital can go to work and areas that are trending positively, right, and putting in higher highs and higher lows, just a better place for your capital to be. Doesn't mean that you have to, again, you don't have to touch things every single day, right? Like I don't touch my positions every single day. Keith touches them every single day. I touch my options positions every single day. but I don't touch my underlying positions every day unless something changes, unless I see something on the page that makes me want to say, hey, this is lower high, or, we're starting to break down here, right? And so that's when I'll start to reduce that position or just get completely out of it and just rotate out. And sometimes I don't have anywhere good to go, to be honest, right? Like last week, last like Thursday, Wednesday, Thursday, I didn't see like good places to go. I there was a big event risk, obviously, with the NVIDIA earnings, and I just didn't really want to play that. And so I was more on the sidelines, and I knew that even if I paid up for something, and you end up having to do that, right? Because NVIDIA was a big move and having from a volatility adjusted standpoint, quite a large move on the market. But my point is that like it's okay just to kind of like sit on the sidelines and just sort of gauge what's happening, and then taking advantage of it when something comes back. But sometimes like you have to act quickly, right? So like the NASDAQ was down 55 basis points today, so that could be your buying opportunity. I have no idea. We certainly were a buyer of QQQ today. Keith was, but that doesn't so if you're looking for like a 5% pullback, those things don't always come, right? So you might want that, but you also might have to be able to act in terms of, hey, let me like kind of dip my toe back in here, or, build up my minimum size position, add 50, 100 basis points so that I have some exposure into this market, or on this piece of inventory that I want to have in my portfolio. So I think, again, you just have to be kind of comfortable with who you are, what you're trying to accomplish, what's in your portfolio, and rotating that around as you see fit. All right. So that's, obviously this is for Hedgeye Nation, right? So I say this all the time, but anybody's got any commentary, if you want to jump up, chat, review some things. A gentleman actually DM'd me. I haven't had a chance to look at it though. I'm really sorry, Mark from Columbus. But I'll take a look and review your question as somebody else hopefully pops up. And so hold on. Is there any other comment? Okay. Yeah. So Mark, I'll DM you back, buddy. And we can talk about that. So one of his questions was just kind of, he just has some process related questions, and this is definitely a great forum for it. We've got a lot of Jedis out there, including Philip, who's jumping up. So again, this whole concept, if you're new to the weekly notebook review, is is me as a former subscriber. I mean, this is where I find the wording kind of difficult, because I'm not really a former subscriber. I still subscribe. I just don't have to pay for it because I work for Hedgeye. So I am an avid consumer of the Hedgeye research to this day, but I was as well, and I actually paid for it. And so when I was a paying subscriber, we started this notebook review with Gavin and Trent Wizzo, and I think we're going on. Heck, it's been 2.5 years, I think, now since we've been hosting this thing on Wednesday nights or Wednesday afternoons, Philip. And so my point is that this is for Hedgeye Nation, right? So this is a good forum to talk process. It's kind of one of my favorite things to talk about, to be perfectly honest. I think it's an ever evolving education. Your game and the way that you approach things will evolve, and they'll adjust, and you'll find new kind of tools or kind of process oriented things that you'll start to develop, and that's the really cool thing, right? Is if you have an inquisitive mind or you want to keep educating yourself, this is a great forum to do it, not only on the notebook review, but also just managing money, managing your own pool of capital, whatever it is, risk management. It's a really fun game. I certainly love it. And but the other great area to kind of talk process certainly is on subscriber orientation. I'm working from Columbus, so that's on Thursdays at noon. You can kind of write in either questions to support or tune in, and we have kind of a Q&A as well, kind of at the end. So feel free to do that. That's a bit, it's kind of marketed a bit more for like beginners, but I, as you might imagine, I try to keep it simple, but at the same time, we go pretty, I cover some good topics, like usually the Git model and the things that are shifting there from an outcast standpoint, and then other components too, like, put up position sizing, stuff like that. But Philip, welcome on, man. I know you texted me earlier that you were getting along with some Eurozone. You like all the green, the ones and twos on the page. That certainly aligns. I think Eurozone's a highly underrated place to be. I also really like the UK. I think the UK in particular is not getting enough love.
There's a lot interesting going on there, right? I think the comments Keith has made over some of the last few days of, like, there actually was a real recession in Europe, right? There wasn't the same ability to kind of save things with a bunch of extra spending, and they actually went through it, and now they're kind of lapping those comps, right? Things are starting to look a little bit better on the quad maps. One thing that I noticed outside, so I touched on some Europe, bought some of that. I do own some of the individual countries, but outside of Europe, I had a question for you, and maybe you can post this to Keith tomorrow. But I've seen in his portfolio solutions, he's got the Philippines and South Korea. He doesn't have Peru. And when I look at Peru looks stronger to me, as looks like a stronger signal. And I'm kind of curious what his, and certainly also not just on the signal, but if you have access to the quad map data, quantitatively, the growth in GDP and the drops in inflation are more supportive in Peru than in other countries. He's talked about copper recently, right? Kind of going right to trend. Copper's it's not quite positive trend yet, but I'm sure a country like Peru and Chile is going to have some correlation with commodities like that. But I'd be curious why Keith isn't long Peru yet and is instead long Philippines and South Korea.
So I don't know. But that's where it's, again, going back to kind of like what I opened with. It's definitely a personal endeavor, right? So he probably just sees. Let me just pull it up one second. Let me pull up. I didn't actually have the. Sorry, one second. Here we go. Okay, so Argentina, Chile, one, and then Peru. Yeah, so basically you've got good acceleration there from our estimate standpoint, and even the decel still at kind of like plus 1.8 on a quarter year-over-year real GDP basis in Q4. So let me check one second, Phil. This is a great question. I think I'm long Chile. Hold on, let me look. That way I can. No, I'm long Israel and Philippines. And
Peru, the signal on Peru looks much better than Chile.
That's
Peru's bullish trade trend and doing the higher highs, higher highs, higher lows. It's all as good as it can be, basically, on signal strength, right?
Yeah. EPU looks great. What's Chile? What's Chile's one again? It's
ECH.
ECH, that's the right. Yeah, thanks. Yeah, that one's not as good. So that one's just starting to maybe break out. You need that one to. Yes, good. No, that was not nearly as good. No. So I would stick with Peru. So Peru.
Well, ECH, it's interesting. I bet you if you overlaid ECH and the copper chart, I bet you they'd look pretty similar.
Yeah.
Copper might look a little better.
He mentioned on the macro show today that he'd be looking to add copper. So copper did actually go bullish trend. I think this morning it was neutral yesterday, right?
It's at 382, which is where
basically
trend is.
Yeah, right there. Yeah. So but yeah, copper. I mean, these are going to trade with sort of precious metals a little bit. So if commodity starts to continue to get a bid, you're going to see that's going to certainly benefit places like Chile and Peru and even Brazil, right? So I think that's certainly one thing to be considering is what is the inflation kind of expectation. We are anticipating or forecasting, I should say, relatively like tight delta still within on the inflationary side, especially on sort of like the G20 space. So if you just kind of look at mode median across G20, we're looking at kind of like 3.09 here in Q1 to 3.05 to 3.18 in Q3. We are seeing a bit more of a jump there up towards kind of like 3.75 in Q4 at the moment on a kind of mode median standpoint across the G20 countries. But in the U.S., that's sticking basically between 3.07, as our nowcast for inflation in Q1, and then it really kind of maxes out at 3.18 right now in Q4 24. Those are all estimates, right? But that's kind of your delta is basically 11 bips. So it's not a big one. So again, I think this inflationary component is very real, and you're seeing that with across the board when you've got oil breaking out, right? Bullish trend. Copper again, kind of holding bullish trend. The one that's breaking down is uranium, but you've also now got Bitcoin breaking out too, and other components as well, right? Like corn and that kind of thing. So Peru looks good, man. I think Asia in general, though, Asia generally has a better signal and has a better quad setup. Just to be perfectly honest with you.
Yeah. Yeah, I agree.
And I suspect that's why he's gone there, because like South Korea will get the benefit, like if China's coming back and starting to look better, that just does start to kind of flow over to a lot of other Asian countries, and also just from a growth standpoint in terms of getting more exposure to growth. Obviously, South Korea, like they just have more, tech and growth semiconductor exposures there as well.
Well, if you get a chance to, or maybe shoot the question over to Jonesy and see tomorrow morning, why?
Yeah, I was just asking about kind of LATAM, generally speaking. Just see what's what. I feel like I think Rooster may have posed Chile or Peru to him last week, but I'll have to look. I'll have to go through my notes. Yeah.
Oh, he definitely mentioned Peru for sure.
Yeah.
Anyway, off of the country ETFs, you mentioned the sitting that trend, and I noticed there's a few different things that are kind of sitting right at trend that I found interesting. I don't know if it means anything yet, but the VIX in particular, the VIX and the volatility of the VIX is basically at like nothingness, right? And it's like yesterday, I think it was a little below the VIX trend. Today it closed like 1380 something.
Yeah, 83.
83, just below trend, but basically like right at it. You look at the move index, the move I think was like 110, and trend last we heard I think was 112. Well, I guess it closed down a little bit more. It closed at 108.71. What was the other one I saw?
Yeah, no, it's the volatility I had not talked about. That's a great call out, and I got to give my buddy Chris a big shout out because he tweeted about the one day VIX 1 day. I mean, that thing was trading down at 7 earlier this morning, and yesterday, and I think the day before that too. So the 1 day, he's like the volatility, the vol complex in general is quite suppressed now. Some of them, basically you did see some appreciation today, and as you pointed out, VIX went kind of right up towards the trend now resistance level. So it's a big call out. VVIX, vol kind of moved higher too, back up to 80. But these are all levels that are really kind of like, they're still very much more so on the low end of the spectrum in terms of 10-day, 15-day, 1 month, 3 month lows, closer to that versus closer to breaking out. So I think you just got to be really conscientious of what's happening across the volatility construct, and in particular for the VIX, looking at shorter dated vol. So again, one that I really pay attention a little bit more closer to than the 1 day is the 9 day, kind of especially in the 0 DTE environment, kind of captures that sort of 10-day trading window. So the VIX 9D is one that's certainly on my watch list, and then obviously going out to the 1 month and 3 month and looking at kind of what that contract looks like. And right now, I think if you go out to October, and maybe it's pricing in more of like the presidential election, stuff like that. But the October contract is, or at least yesterday's close in my notebook, I hadn't pulled it up yet. It was up kind of closer to 20, right? So you may end up seeing kind of as the year progresses, a little bit more volatility in the overall complex. But I mean, I think the biggest takeaway right now is you've got the investable bucket on the S&P 500. So VIX is below 19 or below 18. The VIX, even after today's move, another it was down 55 basis points on the Nasdaq. VIX was up about 1.5%. So, but it closed at just under 18. So it's still right in there in the investable bucket. And Russell volatility, it's in that sort of chop bucket, the RBX at 23.5. But it had been, kind of pushing down towards like the low 20s, right? 23, 20, it was 22, I think, earlier this month. So I would just be kind of paying attention to that, right? Paying attention to what's transpiring across the vol complex. You've got the end of this month, right? So month end is tomorrow. You got a new month that starts Friday, and then we'll start to get into March OPEX, and then you've got the quarterly OPEX as well. So that March OPEX is March 15th. So just kind of pay attention. Jem Croissant, he obviously talks a lot about kind of the Vanna and the charm and those windows, and again, kind of shout out to my boy Chris for continuing to highlight those and pounding them into my face, or reminding me of them. But yes, I mean, I don't know how much those are going to impact things. There was kind of this, window of weakness that people were sort of talking about. Jem was on a couple different podcasts I listened to. They were very good, to be honest. But this kind of window of weakness didn't really manifest. So we'll just see. I mean, I think time will tell. I think the beauty of it all is that the signals will start to pick it up, right? So if you see that VIX, the top end of the risk range of the VIX was 15.73. It was 15.85 yesterday, and I think last week it was in the 16s. On the 22nd, it was 16.43. So those are big time, lower highs on the top end of the risk range for the VIX, and that low end is down at 12.79. So just below 13. Yeah. So if you start seeing that top end of the basically the vol of VIX start to kind of creep back in, and those risk range starting to widen, then that's when I would start to get a little bit, basically maybe a little bit more conscientious and cautious in terms of, hey, maybe I should be a little bit more aggressive of reducing my, position sizing or my exposure to, U.S. equities, and specifically kind of S&P 500 and or other components like NASDAQ or Russell. So that's kind of how I'd be looking right now. Right now, it's an opportunity. It's an opportunity, and you've got so many eyeball discounts out there, man. They're not like huge, Philip, but this morning, I mean, you had SPYs were sitting at a plus 18 premium, but that's a minus 1.2 times on a trailing 12-month Z-score. You got the Qs at a plus 11 eyeball premium. That's another minus 1.2. And then you had IWM at minus 7, which is a minus one time. So again, not huge things. We typically look for 1.5 to 2 or over 2 times on a trailing 12-month Z-score. But I mean, these are great opportunities to be kind of looking at things. And if you're nervous, then like you want to be buying, your protection, your insurance now, right? When premiums are low, and you can go out in time. Like I've got some April SPY puts on the books just for a little protection. These they're not huge. They're 20. No, sorry. I have 30 basis points worth of protection for April 19th. The 490s, just to be fully transparent. So, it's like nothing major. And again, that's not advice, but that's like how I'm, it's the only puts that I got. Sorry, I take that back. I have some March ones too, but, again, but they're small. They're like 15 basis points versus like, 40, 60, 130 basis points worth of, SPY calls. So that's kind of, I got to hedge my book. So that's how I do it. It doesn't mean that's how you need to do it. But that's how I'm doing it.
I thought that was interesting on the call out when he showed this morning on the macro show the volatility curve, implied volatility out for the next 2 weeks or so. Yeah, it's all upsloping, right? This wasn't even with the government tomorrow the PCE potential for government shutdown on Friday or over the weekend. That it didn't. I mean, even the VIX move today and the VVIX, like you don't see a lot of protection buying, even though that curve implies that maybe there should be a little bit more buying.
Yeah,
and
what
what I found most interesting, or what I think is interesting right now, is thinking of the major index change that we've been seeing over the last several weeks of gaining strength is on the Russell side, right? The Russell 2000. And that now is showing that discount he talked about, whereas a month ago it was a premium, right? That's a change. You look at the S&P, the triple Q, and the Russell 2000, that's the only one that's had the discount. It's the only one that's but it's also not significant on a Z-score basis. So I think that's some signs of improvement, and I'll match that up with, so if you wanted to buy protection, you could buy some protection, but how high is it going to go? Then I kind of look at the different buckets of volatility for the RVX. As you pointed out, we're like at 23, right? We're like at the lowest level of the chop bucket. If the Russell is really improving, which we saw the IWM close back below trend today, we're like in this in-between on the super green light of the RVX bucket versus the second tier chop bucket, right? From 23 to like 29. So if I'm not buying protection on it, but if I saw that ramp up over the next few days on some either a PCE thing, or rates move up a little bit and hurt the small caps, or we get a government shutdown, and you get a pop in RVX up to 24, 25, 26, whatever it is, I'm buying that all day long. Like, I'm not concerned. To me, there's no concern of like RVX going all the way to the chop bucket. If we get a pop, like, I would buy that.
Yeah. Again, I think you're gonna start to see it build out in the signal, which you kind of see on the page, right? So right now, though, it's definitely starting to look like green lights, and any kind of pop of volatility is providing at the moment buying opportunities. But that could shift, right? If something happens geopolitically, if something happens, even just with government shutdown or presidential elections. Again, there's so many different narratives.
I mean, if you saw it break trade, that would be a first concern, right? But we're not. Completely. That's not happening right now.
Correct. And that's where I was going to pull up. So last week, not this past weekend, but like 2 weekends ago, I got updated trend on IEF from Keith, and so that's at 94 spot. It was at 94.02. So just to kind of move it to the bonds complex, right? So the bonds to me are also, you're kind of, there's a lot of things that, to your point, that are kind of flirting around trend, right? Like IEF is sorry, I think I pulled up TLT bucks. IEF
the 7 to 10 year.
Yeah, 7 to 10 years. Basically trading like close at 94.03. Again, that trend line has probably moved a little bit, but let's just say, for round numbers sake, call it 94, right? So we've been basically bouncing around 94 for the last week and a half, 2 weeks. And, it's gone down. It's kind of, like basically this trend resistance has been that line right now. And, it can't quite break up through it. And you're seeing that. You're seeing higher for longer in the rates. You're seeing, the rate cuts move out from June, right? They had been March. Now they're, it's just like 60% chance in June. And so, these things, there's a lot of complexity out there in the marketplace, and you're seeing kind of phase transitions happening. Again, it's like copper is a good example. The Russell is a good example. Bond, 10-year bond is a good example. You're seeing it in the signal where you're getting, higher lows, 419 on the 10-year, goes at 4.266. Top of the risk range is 4.40. So that's like well above, the trend level. And that trend level is 4.18 on the 10-year. So 4.18. The low end of the risk range now is just above that at 4.19. So again, that setup is not conducive to like bonds breaking down. That setup is like, hey, there's, you basically got, right now the math is telling you that you're not, you're likely not going to break below trend at the moment as of this morning coming into the day. So, we'll see what happens tomorrow as things progress. But yeah, that's basically what's on the page. And I think that's the beauty. I mean, that's certainly what I love about the Hedgeye process, Phil, and I think you do too, is that I can spin myself in knots thinking about like all the different components of why something's happening. But when you just look at what's actually transpiring and the data that's coming off the page, and then how does that translate into portfolio, into your bucket, right, in your basket, then that's the beauty of it. And like my basket is going to look different than yours, is going to look different than an RA like George's that I see joining here, than John Camprath, who's a family office, and that manages and runs, multifamily office. They're all going to look different, but they're all based in a very similar construct with price volume volatility as the core principles in terms of driving decision making. And on top of that, it's risk parameters in terms of minimizing your drawdown risk while trying to maximize your compounding capabilities. And that's like that's what it all boils down to. That's the holy grail, and that's what we're here to do, which is a lot of fun.
Yeah.
And when you get it right, it's freaking awesome.
Last two things, just to call out on Robert. I think the ITA that's on Keith's chart, defense stocks, that had a little pop today. I was trying to find out which was the underlying that was driving that. Not sure if it was Boeing, I think just based on its weight. But that keeps doing higher highs, higher lows. That today, that wasn't on sale, so that's not an opportunity that wasn't a buy today, but maybe if you wanted to sell a little bit. Who knows what the event risk is related to government shutdown and funding of defense, right? There's almost like never a cap on defense spending. But on the other side, gasoline had a...
UGA,
Yeah, so that went on sale today, right? So you had kind of middle of the range. I don't know what the risk range on it, but I think it was on by my numbers, it looked like it was right around the middle there. Not too far from where Keith bought it. 2 days ago that he had it?
2 days. Yeah, 2 days ago. Yeah, exactly.
Yeah, so it's basically like just about the same spot. I would think that would be a place where you would add or take it down to your minimum, right? If you're kind of sitting right at trend where he added it. But just a call out there on gasoline that not everybody looks at daily.
Yeah, good call out. And I think this is a great one where, so in the ETF Pro, the trend risk range is 63.94 on the low end for UGA and 68.34 on the top end. So that 68.34 is, 38, 68.38. I don't believe that would be a 1 month. Yes, that's closing basically right at the 1 month and 3 month high, which is 68.37. That's where it closed. So that's a tricky one. That's a signal where it's like, it's been good. He didn't actually add that today in terms of exposures, which again is also kind of a signal in itself, saying that, with his kind of refresh risk range, that top end of the risk range may have come down a little bit. So and that is not signaling kind of new 1 month and 3 month highs. So I'd be careful, or not. I'd just be conscientious. It's still bullish trend, right? And it has not removed from ETF Pro. But I think this is a perfect example of where people try to go and they kind of hunt around. And it's like, oh, it's red. We should add more to this. But the low end of that risk range is 63.94, which is almost like $2 below where it closed today. And so,
that's on a trend basis, right?
That's on a longer, exactly right. That's on a longer term trend. 100, absolutely, Philip. But at the same time, it's one of these things where, if you already have the exposure on, then just sitting there with a min or mid size, whatever your half position, that's a beautiful thing to do, right? You can take a little bit off the table, hopefully take some profits, and you can just kind of let it sort of sort itself out, right? And see what it does. And if you buy it back up at $67, then so be it, right? Because you know that it's regained some signal strength. And yeah, sure, you didn't get it under 66, but you're buying it at a better decision point in time. Because right now it's teetering on a little bit, it's putting in that first lower high, and we'll just have to see what transpires. So
I think that's a good case example for someone who's trying to learn the Hedgeye process and follow it, in the A/B test that Keith has talked about. The first thing is, and you just mentioned it, Robert, was making lower highs, right, on the risk range. So check that box, right? The last few days, I believe it's been making lower highs.
Yep.
Then you want to look at, where are you on a trade basis? Well, right, because if you break trade, then the probability of you going a trend goes up.
100%.
You're like right there, right? and we've talked about well, how do you risk manage when something's at the low end of the risk range, when you're at trade and you don't want to have a big loss going to trend, right? And so that's where for someone, I think this is just a good learning case for someone to watch over the next few days and see what happens with gasoline. Does this thing break trade and go down to trend? Should you have gone down to your minimum here? What does Keith do? What did he do today? What does he say tomorrow about something like this? This is, I think it's a learning example.
Yeah, it's sitting at his very last position.
Right.
So, and he reduced 50 basis points on the 26th. So that was 2 days ago, on Monday. I moved back over. Sorry, I moved to oil for a second. Yes.
And he probably, what was copper relative to gasoline?
Copper was just added. Copper's like
they're both like
two, basically right at the launch of the race.
They're both in the same spot.
Right? Basically the same spot. Yeah. So, it's, yeah, exactly. And Copper's added yesterday at his min sizing. So, this is a really good case study. And to me, listen, I'm not really a technical guy, but like, if you just look at what the 10-day and 15-day low is, it was, 4 or 5 days ago, basically on the 23rd, last Friday, and it closed right at 64.98, so rounded out to 65. So that 65 level is really important. If it, in my mind, if it starts to break that, then it's sort of got near-term momentum to the downside, and that's where I would be probably out. That would be my out. Really good call out though, because I'd actually not looked at UGA. Yeah, good call out. Really good call out. I noticed it was the very last position this morning when I wrote it down, but I did not pull up the chart yet. The other one that's just this weekend. So again, if you're a Macro Pro subscriber for Hedgeye, I started to publish these top 6 or 6 key insights, I should say, to stay ahead. They go out on Sundays. Take a lot of work, so hopefully you guys are liking them. But the 3 of the things I called out this past weekend was what was it? Sorry, it was momentum, so SPMO, bulk dry, and AMLP, and they all 3 of them continued to really have really strong signals, and AMLP kind of, I think, gave you a little bit of an opportunity last couple of days. So if you're not long that one. And it kind of gives, I believe it gives you a dividend in a couple of weeks. But yeah, it was down.
That's one of those
down about 1%.
That's that better example, right? Where you keep making higher highs as opposed to gasoline making lower highs.
Correct. Yeah. So AMLP, that top end of the risk range, again, the trend one from ETF Prep product on Monday mornings is 46.93, and that would be a big time new 1 month and 3 month high. And so yeah, the low end of the risk range is all the way down at 43.35. So that would be kind of below the 1 month low, but we're kind of right around it actually. But it's but that's again, he did not add AMLP today on the pullback, but again, this is one where if you aren't long MLP and energy and in particular oil continues to hold up on its signal strength, these guys pay a good dividend, and it's high quality companies, right? So low all the factor exposures kind of line up in terms of low short interest, all that kind of thing. And so so that would definitely be on my short list. The AMLP would be on the short list in terms of like adding, as long as it kind of doesn't really kind of break down further from here. All right. And I guess again, just to help people out, we did launch a new product this week called Signal Strength. Signal Strength, I think it's called Top Signal Strength Longs. And again, it's pretty, I don't want to say basic, but it's I think it's basic. It's beautiful in its simplicity, where it really just takes key signal and the analyst coverage list, and it meshes the two, and it just gives you the top exposures ranked by time held of that bullish trend and trade signal. So it really just kind of narrows down to call it 300 different companies that are inside of the general universe of coverage, the coverage universe, I should say, and kind of boils it down. Right now we have 60. In the past, I've seen it only have 18 to 25. But right now, there's a lot of things that are kind of signaling bullish trade and trend. And that list is probably the biggest I've seen it since joining in October of 2022. So that should tell you something about the current setup. X2 just texted me, so thank you. Euro USD been sitting at the top of the risk range with an bearish trend. Okay, so I just got a question on the Euro US dollar. I've been sitting at the top end of the risk range within a bearish trend. Why hasn't he signaled sell? Because I believe, see, 101.85. Yeah, that top end of the risk range really hasn't done much. That risk range hasn't done much. There hasn't been a whole lot of volatility, X2 in the euro. Basically, on the 22nd, the risk range was 1.071 to 1.085. Today is 1.072 to 1.085. I suspect there's just like a little bit better places to park some capital and to kind of take advantage of on the short side. But at the same time, where's FXE? Sorry, because we get that risk range, 118. Yeah, the risk. Yeah, I mean we're sitting right there. That's one where, yeah, the euro does. That looks like a prime opportunity right now. Let me pull up the actual euro.
I think today was the first lower high day on the Dixie, wasn't it? Even I know it's not the same as the euro cross, but it's a lot of euro.
Yeah, it's like 60%, I think. That is true, and yeah, that's an interesting one. I don't want to cop out here, XT, but euro's either going higher or it's going lower, which is not very helpful, and I understand that. But you're in a bit. I think you're in a bit of a spot. Yeah, that 1.085 kind of level, which is top of the risk range. If that puts in this is one where I think is like a wait and watch situation. If it starts to, it's had kind of 3 down days in a row. If it has another one, this is another good example where I'd rather add it at like 1.081 or 1.082 and see that kind of continuation of it just putting in a new lower high here, which it did on the Euro USD. That was on Monday, the 26th. It closed at 1.0851. So that could be kind of the first lower high, kind of really significant kind of lower high, like bounce off of the lows. And that's a good one. So yeah, I'd almost be waiting, just kind of let it breathe another day or two. And honestly, in this case, it'd be better, in my humble opinion, to see continued weight weakness and to like pounce on it and add it, if it kind of continues to break down, sub 1.083 or something like that. And ideally you would see the top end of the risk range of 1.085 come down to, 84, that kind of thing. So that would be another great signal in terms of you get that and perhaps a lower low as well in conjunction. And that would be a great 1-2 punch. The low end of the risk range right now, the 1 month low and 3 month low is 1.07085. So the low end of the risk range is 72. So what that's also indicating is that you'd be getting a lower high here at 85, but you'd also be getting a higher low at 72 based on kind of recent price action. So that's not a phenomenal setup. You're really kind of getting a little bit of consolidation there. So that's where you'd want to see that low end kind of move lower, and certainly the top end of the risk range come down a little bit too. But Euro's kind of a bit of a wait and watch here. Hopefully that was helpful. That's a great set. We've had some really good test cases here, or whatever, whatever you want to say. So Euro USD, it's a great example here. If you've been short that thing from like 111, you've crushed it. Even if you got caught it at 110, hell, that's a great move. The gasoline's a great one too in terms of UGA. That's a prime example of something that we're long it, you're adding to it, but then you kind of basically hit pause on it. So that's a really good example. And then there's the other one, which is Bitcoin, which basically just goes to the moon. And I kind of I almost somewhat promised myself, Philip, that I wasn't going to talk Bitcoin today, but hard not to. All right, anybody?
That's okay. It's just mooning, right? So like, it's the higher high, higher low. Bullish trade trend. Like, how much more signal strength would you like?
Exactly. And unfortunately, again, I don't have that one in the old PA. which is really shitty. But it is what it is, and I'm not really going to dwell on it too much either, because there's a lot of good things in there. But yeah, anyway, listen, anyone listening in, by all means, please jump up, chat. Happy to take any other questions, talk about anything else. The one that is kind of interesting, again, Philip, I don't know if you've looked at high yield growth, HYG, lately.
Yep.
That moved on, obviously moved the bullish trend. We took it off our bearish short list, which we had on for ages. And in kind of the last 15 days, month, really almost the last 3 months, it's kind of traded, well, maybe not 3 months, 2.5 months. It's traded sort of sideways between, 70, called 77, 76.5 to like 78. Really, the interesting thing here is it does have a nice it has a nice eyeball premium, plus 62%, and that's a plus 2.9 times on a trailing 12-month Z-score. So that's a nice little setup there. Obviously, we don't have that officially on the bullish side from an ETF Pro standpoint, but it's bullish on the page within the risk range. 77.60 is the top in the risk range. Low in the risk range is 76.70. That is not a 1 month high nor a 3 month high. It would be a kind of a higher low, but you do have some kind of like higher prices falling out of the 1 month look back window. So if you give this kind of, again, I'd kind of like, if you get a little bit of a pullback the next week or so, I think that could be an interesting one. If it goes to low end of the risk range, it kind of holds that, 76.70, 76.80 level, would be a really interesting one to perhaps start adding to on the long side, because with the anticipation that you would get kind of new one, but just because of how the look back window looks, you're just going to naturally, basically this 15, the high from the February 9th of 77.36, that's going to start to be the new 1 month high, right? So that's a nice little setup. And then when that happens, that 77.60, if it's still there, that would be new 1 month high. So that's just one I wanted to call out, would be HYG. Obviously, we've been bearish that bad boy, as I said, for a long time. I think going all the way back to early 2022. I think it was March or so. In April. So yeah,
what's interesting about, I think there's two call outs on that. One is, I think it's a perfect signal strength case. If you pull up the chart of EWI, which is completely unrelated, but a very similar path, right? So that's Italy.
Yeah.
But you have this initial move on like a 3 month trend basis. You see it go trend positive or trade positive, then trend positive, and then they stop and they just move horizontal, right? And you, the volatility bleeds out. You get eventually lower highs, but it just keeps moving sideways and never breaks trade. Mm-hmm. So you never have the breaking of trade that increases the risk of going to trend or breaking trend. So it just kind of sits sideways. At the same time, you see other things that continue to make higher highs and higher lows. And so you see these obvious divergences in signal strength, right? It's a very easy, it's a great example of being able to quickly discern what is kind of a medium signal strength versus a strong or great signal strength.
Yep.
And then the other thing I wanted to call out is where we see rates going. Yeah, it's interesting that we're talking about like rates being, at least on the long end, bullish trend, and it's not affecting anything high yield. At the same time, we're like making our way through the quads and showing some improvement of maybe a couple months of quad twos here going out 2 to 3 months. And this thing, you're like right in the middle where you have no idea if this thing's going to break down to trend or if it's going to all of a sudden pop up like some of the European countries.
No, exactly. You're right.
Exactly. Yeah. Like where the yields keep going down to like trend, where you're just like at the low end of the risk range, right at those trend levels. These things are all correlated where you're like, are they going to break up or break down? Who knows?
Yeah, no, you're spot on. And And, this is where, again, it's kind of a little bit of similar sets where you've got the Russell picking up signal strength and obviously moving to bullish trend, and you've got kind of the high yield as well. Again, it's not like obviously perfect correlation, but you see, there are, as you're saying, like kind of multiple components there across different asset classes, different just different sectors that are certainly worth paying attention to, and they are giving you signals that are a little bit mixed, right? And it wouldn't take much. Again, the low end of the risk range on the 10-year is 4.19 as of this morning. That trend level is 4.18 as of 2 days ago, I think it was. So actually yesterday morning, we reiterated it was 4.18.
Yesterday,
yeah. So, so again, would take, the probability, the risk range to provide you with like high level of probability of where price action could go. But it doesn't mean they can't go, break down further than that. Also doesn't mean they can't break out more than 4.40, which is the top of the risk range, which would be new 1 month and 3 month highs on the U.S. Treasury 10-year. And if we get that, then we may very much be kind of moving back up towards, who knows? I mean, the high of October-ish was like around 5%. So could we get 5% again? Could we get north of 5%? I really don't know. I think right now, for me, the longer end of the curve is certainly in a wait and watch situation. And if I've got to lean one way or the other, it'd be more bearishly than certainly positively at the moment. But SHY, I think there's the shorter end of the curve is looking to be a little more stable, I guess, in terms of kind of the longer term outlook and that kind of thing. So we'll see.
So you have the move breakdown too below the trend.
Exactly. Yeah, closed at just under 109. Another great call out. So
I think
it's healthy.
The HYG to me, the takeaway is I think you've been good at keeping me honest on this. And sometimes I'll text you something and it kind of looks mediocre, and you say like, well, why would you go into that when you can go into something with the stronger signal strength, right? So you could say, take a look at HYG and then look at pink and ask yourself, which would you rather be in? Why force HYG when you could be in pink?
Yeah. Yep. No, that's a good point. Yep. Sometimes though, I tell you, yeah, it's a great idea. And sometimes I say thank you. The best is like when we're basically doing the same decisions on the same, very similar time frame. That's always when it's like, yep.
Yeah, you confirming
you
that's
you get the benefit of like do some single stocks. I'd prefer to kind of do some single stocks, but I think stick with the ETFs. That's okay. It was funny. What was it last week, Philip? You were texting me, and I was like, "Yeah, I added some industrials," and you're like, "Perfect." I forget what you added, but basically, you're like, "I did a lot of the major underlying."
Yeah, I had all those underlyings. I'm like, "Yeah, like, awesome. That's working."
Awesome. Yeah, exactly. Yeah, I prefer those because you get more juice off those bad boys. If you get them right, they can really move. But I like the juice, Philip. I like the juice. Perfect. All right. Well, we've been at this for an hour. I don't know if anybody's again happy to take some questions or what have you. I can talk stocks and markets for days, hours. But I would also like to get a little bit of dinner. How's the West Coast, Philip?
It's gorgeous out here. I think we're just about done with the rain season.
Oh, that's good. That's good. It was a rainy, it was a warmer day here in Connecticut, but it was very rainy. All right, well, good stuff. Thanks, hey Philip. Thanks for popping up, man. Always a pleasure. Makes the engagement so much more fun. So I appreciate the back and forth. Thank you all for listening. Always honored that you spend an hour, often an hour plus, with me on a Wednesday. So thank you for that. Hopefully you found it valuable and helpful. And we will be back next week, probably 4:30 again on Wednesday. But I'll keep everybody posted. Enjoy the rest of your week. Good luck out there. And we will see you soon.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.